Hey everyone, welcome to The Explainer. Now, I am absolutely thrilled you're here today because we're going to deconstruct something that, well, it sounds incredibly complex at first glance, but it's actually deeply fascinating once you see how it's built. We are diving into the mechanics of professional audit planning. And look, whether you're totally new to the financial world and just looking for a user-friendly guide, or you really want that in-depth structural knowledge, this explainer is built from the ground up for you. We're going to turn all that complex knowledge into a highly accessible, beginner-friendly strategic blueprint.
So imagine walking into a massive multinational corporation, right? You've got millions of transactions flying around, insane IT systems, thousands of employees, and you have just mere weeks to verify if their financial statements are actually accurate. So how do auditors tackle these massive corporate financials without getting completely lost in the chaos? I mean, if they just walked in and started looking at random receipts, it would be a total disaster, right? The ultimate structural solution to this whole mess, a rigorous, meticulously crafted audit plan.
Okay, let's dive into this. To build this metaphorical house step by step, we've got a clear roadmap today. We'll look at the purpose of audit planning, strategy versus detailed planning, knowing business and industry, navigating audit and business risks, materiality, which is what really matters, and finally, timetable and team responsibilities. Don't sweat it if some of these terms sound alien right now. We are going to break every single one of them down perfectly for you.
All right, kicking things off with Section 1, the purpose of audit planning.
Before a single number gets tested or a single document is handed over, we really have to ask, why? Why do we plan before we act? Well, planning ensures the entire audit is effective, efficient, and properly staffed. Think of it like mapping a minefield. It lets auditors identify high-risk areas early on so they know exactly where the major traps might be hiding. It helps us allocate the most experienced staff to the toughest problems. It sets materiality, which again we'll get into shortly, and helps design the exact right testing procedures. Crucially, it coordinates efforts with the company's management so we avoid those painful last-minute issues, hit our reporting deadlines, and keep our documentation rock solid. Now, there is a profound warning here that we absolutely have to heed. Without business understanding, audit becomes mechanical and weak. Honestly, this is the core philosophy I want you to take away today. If an auditor just acts like a human calculator, blindly ticking boxes on a checklist without actually understanding how the business makes its money, the audit is basically useless. Understanding the foundation is literally everything. Moving right along to Section 2, strategy versus detailed plan. Think of this phase as the difference between the lead architect designing a skyscraper and the construction crew actually pouring the concrete. They are two totally distinct yet deeply connected things. The audit strategy, that's the grand architectural blueprint. It's the big picture. It dictates the overall scope, the reporting objectives, the timeline, the major risks, and big picture decisions like, hey, which global locations are we visiting, and do we need external experts? Conversely, the audit plan is the execution roadmap for the crew. It's way more granular. It outlines the specific nature, timing, and extent of your procedures. This is where you're deciding your exact sample sizes, which specific control tests to run, and exactly who on your team is doing what. So, as you can see, this builds into a very logical funnel. Step 1 is defining that big overall approach, the strategy. Once those major decisions are locked in, it naturally flows right into Step 2, detailing the granular procedures, the plan. And only after those two are absolutely set in stone does the team move to Step 3, actually executing the procedures. You simply can't execute if you haven't planned the details, and you definitely can't plan the details without a massive guiding strategy. Next up, Section 3, knowing business and industry. Remember that quote about not being mechanical? Well, this is where the auditor has to think exactly like a seasoned industry insider. Before looking at a single spreadsheet, an auditor must understand the fundamental business elements. What exactly does this entity sell? How is the revenue actually earned? Who are their key customers and suppliers? You have to scrutinize their cost structure, how they get their financing, the strength of their IT systems, the regulatory rules they're bound by, and, oh, this is a big one, management incentives. Why management incentives? Well, think about it. If a CEO's million-dollar bonus is tied directly to hitting a specific revenue target, the risk of them inflating those numbers goes way, way up. And this brilliantly illustrates how a company's sector heavily dictates the auditor's entire focus. If you're auditing a construction firm, your major risk is how they recognize revenue on those massive half-finished projects, right? Known as work in progress or WIP. But jump over to a bank and the risk shifts entirely to expected credit losses and regulatory capital. Retail, you're hunting for stolen or lost inventory, also known as shrinkage. Software, capitalizing development costs. And asset management relies entirely on the accurate calculation of net asset value. Basically, the industry defines the risk landscape and the auditor has to adapt to it. Now, beyond just the industry, the auditor has to assess specific business risks. These are threats that might cause a company to just flat out fail its own objectives. We're talking about things like losing a major customer, sudden product obsolescence, cyber breaches, or a massive supply chain disruption. What's absolutely crucial to grasp here is that many of these real-world operational risks directly translate into financial reporting risks. Like if a company suffers a massive cyber breach, there are huge financial liabilities that need to be recorded accurately as a result. Make sense? All right, let's look at Section 4, Navigating Audit and Business Risks. We've talked about the risks to the business itself, but now we've got to shift our focus to the specific risks the auditor faces when they actually sign off on the financials. Let's slow down for a second here, because this formula, it is the holy grail of auditing. Audit risk equals inherent risk times control risk times detection risk. But what actually is audit risk? Put simply, it is the terrifying possibility that the auditor gives a clean opinion, saying, yep, everything is fine, when in reality, the financial statements are materially misstated. Let's break down the 3 parts of this formula so you can see exactly how that nightmare scenario happens.
I want you to think of this as a progression of failing safety nets. First up is inherent risk. Just by the very nature of this specific business, how likely are errors before we even apply any safety checks? Next is control risk. This is the risk that the company's own internal safety nets, their internal controls, completely fail to catch the error. And finally, we have detection risk. This is the auditor's last line of defense. It's the risk that our own testing procedures fail to detect that massive error that already slipped through the first 2 nets. Which brings us to Section 5, Materiality. What really matters? So, with all these risks identified, how do auditors actually know what size of an error matters? Well, materiality is arguably the most vital threshold in the entire financial world. And the crucial point here is this. Materiality is not about achieving absolute penny-perfect accuracy. Nope. A misstatement is considered material only if it could reasonably influence the economic decisions of the people using the financial statements, like a potential investor or a bank giving a loan. Materiality is the absolute compass of the audit. It dictates how you plan, how big your sample sizes need to be, the extent of your testing, and ultimately your final audit opinion. Let's make this concrete with an example. Imagine our overall materiality for a hypothetical audit engagement is set at 10 lakh rupees. This means any error or combination of errors larger than this exact amount would legitimately change an investor's mind about the company. If an error is bigger than 10 lakh, an investor might panic. So this number becomes our big red line. But here's the kicker. Auditors don't just use one number. While the overall materiality might be 10 lakh, they strategically set a lower, tighter buffer called performance materiality, let's say 6 lakh. Why do they do that? Well, because you might have several hidden, undetected misstatements of, say, 2 lakh each. Individually, they seem totally fine, but together, they add up and cross that big 10 lakh line. Setting a lower performance materiality strictly prevents that from happening. And finally, there's a clearly trivial threshold set much, much lower, maybe at 50,000. Any error below this is just absolute pocket change, and frankly, it isn't even tracked because it would just waste everyone's time. And finally, Section 6, Timetable and Team Responsibilities. Now that our blueprint and our safety thresholds are set, it's time to actually bring the grand design to life. Every single audit has a really rigorous life cycle. It kicks off on day 1 with the planning date. Around month 6, we might jump in for an interim audit to test the company's internal controls early on. Month 12, that's the massive one. That's the year-end audit and physical inventory count date. During this crunch time, the team is scrambling for bank confirmations and debtor checks, and finally, by month 14, we hit the finish line. We get management representations, partner reviews, the final audit committee meeting, and that ultimate report signing. So, who exactly is doing all this heavy lifting? Well, everyone has a highly specific role based entirely on that initial plan. The engagement partner carries the ultimate weight. They are responsible for the overall audit quality, and they are the ones signing the final opinion. The audit manager handles the high-level planning, supervision, and review. Your seniors, they execute the fieldwork right there on the ground, while the associates are doing the daily grind of testing and documentation. And don't forget the specialists. These are the IT, tax, or valuation experts brought in for the really complex brain-melting data. But here's the thing.
every single one of them relies entirely on that foundational strategy. Which brings us to the end of our explainer, and I want to leave you with a rather provocative thought. If the foundation is flawed, the whole house crumbles, right? So if the strategic blueprint fails from day one, if the risks are misunderstood and materiality is totally miscalculated, can the final audit opinion ever truly stand? Planning isn't just some boring preliminary step, it is the undeniable linchpin of financial truth. Think about that the next time you're scrolling through a massive corporate financial report. I really hope you walked away with a rock-solid, in-depth understanding today. Keep learning, keep questioning, and I'll catch you in the next explainer.